Hi everyone. In this video, let's understand asset allocation. Maximize your investment returns. So, what is asset allocation? Asset allocation means how you divide your money into different things like stocks, gold, FDs, real estate, etc. For example, if you have 1 lakh and you put 50,000 in stocks, 30,000 in gold, 20,000 in fixed deposit, that's called asset allocation. So, why it's important? If stock prices fall, gold or FD may protect you. It gives balance to your investments. So, the next is different types of asset classes. Think of these like buckets, like equity, stocks, mutual funds, high growth but risky, debt, like FDs, PPF, bonds, low risk, steady returns, gold, physical or digital, safe in tough times, real estate, land, property, long term growth. So, cash, emergency money in bank or liquid funds. So the alternative is crypto, international funds, new age, and it's a risky also. So each one behaves differently. That's why we mix them. So the next is why is asset allocation so important? It protects your money if one thing goes wrong. It gives stable returns year after year. It makes sure you don't panic during market crashes. Think of your portfolio like a tali. You don't just eat rice, right? You want dal, curry, curd, papad too. So what is diversification? Diversification is equal to splitting your investments within and across asset types. Examples, don't buy only stocks from one industry like IT. Don't keep all your money in gold just because it's trending. Benefit. If one investment is not doing well, the others will balance it out. So the next is know your risk level. Everyone has a different comfort level with risk. Types. Conservative. Feels nervous with ups and downs. Prefers FDs, depth. Moderate. Okay with some risk. Likes mutual funds goals. Aggressive wants high growth. Ready for stock market swings. Before investing, ask, can I sleep peacefully if my investments go down by 10%? If no, stick to safer options. How age affects asset allocation. Simple formula 100 minus your age, that is equal to percentage in equity. Example, if you are 30 years, 100 minus 30, that is equal to 70% in equity. If you are 60, 100 minus 60, that is equal to 40% in equity. As we grow older, we need safer investments. So the next is goal based allocation. Different goals need different types of investments. Example, emergency fund next month. So keep in savings or liquid fund. Vacation for 2 years. Use debt mutual fund or FD. Child education for 10 years. Use equity mutual fund. Retirement for 20 plus years. Mostly equity, some gold, some PPF. Don't use the same investment for all your goals. So the next is how long you will invest, time horizon. The longer you stay invested, the more risk you can take. Investment time types. Short term 1 to 3 years use safe assets like FDs, liquid funds. Mid-term like 3 to 7 years mix of equity plus debt. A long term 10 plus years, mostly equity for high growth. Match your investments type with your goal timeline. Strategic versus tactical allocation. Strategic allocation is equal to set a plan and stick to it. Tactical allocation is equal to adjust according to the market. Example strategic. I will always keep 60% equity, 30% debt, 10% gold. Tactical. Market is falling. I will increase equity this month. Beginners should go with strategic, not emotional moves. Rebalancing your portfolio. Your allocation changes when markets move. You must rebalance it. Example, your equity grew from 60% to 75%. Rebalancing is equal to sell extra equity and put in debt or gold. Why do it? Keeps your risk under control, helps book profits. Do it once a year or when one asset grows, shrinks too much. Common mistakes people make putting all money in one thing, not reviewing investments, investing without knowing risk, following friends blindly, panic selling, and markets fall. Have a plan, stick to it, review once a year. Simple portfolios. Example portfolios by budget 1 lakh. is a budget 50,000 in mutual fund, 30,000 in gold, 20,000 in FD. If you have 5 lakhs budget, 2.5 lakhs in equity, 1.5 lakhs in PPF bond, 50,000 in gold, 50,000 cash or liquid. Suppose you have 10 lakhs, 5 lakhs equity, a mutual fund plus stocks, 2 lakhs debt, PPF NPS, 1.5 lakhs gold, 1.5 lakhs REIT or FD. Best tools and apps to help: IND Money, Portfolio Tracker, Covera, Goal Planning, Grow, Economic Times Money, SIP and Mutual Funds, Zeroda, Direct Equity, Coin for Mutual Fund. Use Excel if you like. Manual control. Create your own plan. 6 easy steps. List your goals. Find out your risk level. Choose which asset classes to invest in. Divide money wisely. Start investing. Review and rebalance every 6 to 12 months. Set a calendar reminder to review yearly. The psychology behind asset allocation. Emotions affect money decisions. Fear and greed often ruin good strategies. Asset allocation brings discipline and reduces emotional reactions. Helps us stay calm during market crashes. Don't change allocation because others are panicking. Stick to your plan, not the market noise. Emergency fund is equal to your first level of asset protection. Should be 3 to 6 months of expenses kept in. Liquid mutual fund, sweep FDs, savings account. Not an investment but a buffer. Without this, you're forced to sell at a loss in emergencies. Tax implications of different asset classes. Equity mutual funds, LTCG above 1 lakh taxed at 10%. Debt mutual fund fully taxed as per slab. PPF tax free. FDs interest fully taxed. Gold physical 20% LTCG after 3 years plus indexation. SGBs tax free if held till maturity 8 years. Understanding tax helps you optimize returns legally. The real return is equal to after minus tax return. Asset allocation during market crashes. So don't panic, sell. Your allocation already protects you. Rebalancing during crashes: buy low, sell high naturally. Historical fact: diversified portfolios recover faster than single asset portfolios. Stick to long term plan unless your goal change. Crisis is not the time to redesign your ship. It's time to steer steadily. So the next is international asset allocation. Add exposure to US markets or global funds for currency diversification. ETFs like Motilal Oswal, Nasdaq 100 or S&P 500 funds helps balance Indian market risk and inflation. If INR weakens, international exposure boosts returns. Inflation, the next is inflation protected asset allocation. Inflation slightly eats your savings. Asset allocation must include growth assets like equity to beat inflation. Add inflation indexed bonds if available. Avoid holding too much in FDs, savings, cash long term. Goal is grow your wealth faster than inflation grows prices. So the next is DIY versus hiring a financial planner. DIY is equal to you control everything. Learn, plan, track. Planner is equal to expert guidance, saves time, avoids mistakes. Choose planner if you are too busy, you're emotional about money, you don't understand investments. Even if you DIY, consider one time consultation for your allocation. So the next is smart asset allocation tools and apps. Apps that help you track and plan. Covera, IND Money, Zeroda Coin, ET Money, Excel sheet tracker for manual lovers, robo advisors, auto rebalance and plan for you. Use tech to simplify rebalancing and goal tracking. So the next is asset allocation for children's future. Long term frame is equal to more equity in the beginning. Reduce equity as goal nears. Suppose if child turns 14 plus. Use equity mutual fund early years, debt plus PPF final years, Sukanya Samruddhi for girl child. Don't touch this allocation for any other goal. So the next is retirement oriented asset allocation. Focus on safety plus steady income. Mix of senior citizen savings scheme, monthly income plans, debt mutual fund, real estate rentals if manageable. 20 to 30% equity for inflation beating growth. Retirement is equal to a preservation mode with slow growth. So this is the end of the video. If you found value in my video, give a thumbs up, subscribe to watch more videos. Also, in the below, there's a description to join for my free webinar, Transform Your Finances. Click the link and join for my free webinar and start growing your wealth today.